Brand new cryptocurrency portfolio. Knowing what I know after investing in cryptocurrency for more than 5 years,
cryptocurrency has emerged as a dynamic and potentially lucrative investment opportunity in recent years. However, the volatility and complexity of the crypto market necessitate a strategic approach to portfolio construction. This video will guide you through the process of building a winning crypto portfolio that maximizes your gains while managing risk effectively. To begin, it's crucial to understand what a crypto portfolio entails. A crypto portfolio is a collection of cryptocurrency investments that an individual or entity owns and manages. Much like a traditional investment portfolio, it reflects the variety and balance of assets held, which can include coins, tokens, or other blockchain-based assets.
Determine whether a crypto asset is a security is clear.
Each asset serves a purpose, whether it's for long-term holding, generating passive income, or leveraging short-term price movements. The primary goal of building a well-balanced portfolio is to minimize the impact of the volatile market by managing risk through diversification. Creating a well-balanced crypto portfolio by diversifying the assets you invest in can significantly reduce your exposure to risk while increasing exposure to a broader range of digital assets. Before delving into portfolio construction strategies,
calculated bets. You don't need 1,000 trades.
It's essential to familiarize yourself with the various types of cryptocurrencies available in the market. Payment-focused cryptocurrencies such as Bitcoin, Ripple, and Litecoin are designed as digital alternatives to traditional currency. These coins typically have a high market capitalization and are considered more stable within the crypto ecosystem. Stablecoins like Tether and USD Coin attempt to offer relative price stability. Their market value is usually pegged to the value of a stable asset, like USD, the euro, or gold.
Tolerance for each project that I invest. For example, I will only risk 1 to 2% on a very risky project.
And unlike other crypto assets where prices can fluctuate wildly, stablecoins are designed to maintain a stable value over time. Utility tokens such as Ethereum and Binance Coin serve a particular purpose on a specific platform. They allow users to interact with features or applications unique to that platform. Sometimes utility tokens are used to pay for products or services on a network, while other times they function as the means through which a user can unlock a network's utility. Governance tokens like Uniswap and Aave provide holders the right to vote on issues that guide the development of a blockchain project. This allows projects to distribute decision-making power to their community of token holders.
How to find even more hot altcoins before anyone.
Now that we've covered the types of cryptocurrencies, let's focus on the strategies for building a well-balanced portfolio. The first principle to adhere to is diversification. Distributing your investments across different crypto assets helps manage risk and optimize returns. When constructing your portfolio, it's crucial to define your investment goals and risk tolerance. Are you looking to build long-term wealth, generate passive income, or simply diversify your investment portfolio? Your goals will guide your strategy, influence the types of assets you include, and determine your approach to risk management.
Came crashing down more than 95%. It hurt a lot.
Establish specific, measurable financial targets. For instance, achieving a certain percentage return on investment, generating a certain amount of passive income through staking or yield farming, or building a portfolio worth a specific dollar value within a set time frame. Clear targets make it easier to measure progress and stay motivated. Decide on your investment timeline. Are you looking to hold assets for a few months, several years, or even decades? Your time horizon will influence the types of assets you prioritize, as some cryptocurrencies are better suited for long-term growth, while others may offer short-term volatility opportunities. Assessing your risk tolerance is another critical step in portfolio construction. Cryptocurrencies are known for their price volatility.
Able to pump up so high, they also come crashing down. In fact, many altcoins go down 90-95%.
And your ability to handle risk plays a very important role in determining how you invest. To maintain financial stability and peace of mind, align your investments with a level of risk you are comfortable with. With these foundational principles in mind, let's explore some specific portfolio allocation strategies. A conservative portfolio might look like this: 50% Bitcoin, 30% Ethereum, 10% Binance Coin, and 10% Cardano.
You can see that 50% is in Bitcoin, 25% is in BNB, and 24.93% is in Ethereum.
This allocation focuses on established cryptocurrencies with larger market caps, which are generally considered more stable. A balanced portfolio might consist of 40% Bitcoin, 30% Ethereum, 15% Solana, 10% Polkadot, and 5% Chainlink. This allocation maintains a strong presence in established cryptocurrencies while also including some promising altcoins for growth potential. For those with a higher risk tolerance, a growth portfolio could look like this.
When to cut losses. This would be if I'm down 1x, 5x, 10x, or even more on a project.
30% Bitcoin, 25% Ethereum, 15% Binance Coin, 15% Solana, 10% Polygon, and 5% Avalanche. This portfolio leans more heavily into promising altcoins, which could provide higher returns, but with more risk. A speculative portfolio might include 25% Bitcoin, 20% Ethereum, 15% Dogecoin, 15% Shiba Inu, 10% Polkadot, 10% Chainlink, and 5% Aave. This portfolio includes meme coins like Dogecoin and Shiba Inu, adding more volatility and potential for high short-term returns with foundational assets still included. It's important to note that these are just examples, and your ideal allocation will depend on your personal goals, risk tolerance, and market outlook. Regular rebalancing is crucial to maintain your desired allocation as market conditions change. To effectively manage your crypto portfolio, consider using a portfolio tracker. These tools help you monitor your investments, track performance, and make informed decisions. Popular options include CoinMarketCap, Pionex, CoinGecko, and Delta. When choosing a tracker, consider factors such as security features, user interface,
create a brand new crypto portfolio if I had $1,000 to spend,
and compatibility with the cryptocurrencies in your portfolio. As you build and manage your portfolio, it's essential to stay informed about market trends, regulatory developments, and technological advancements in the crypto space. This knowledge will help you make informed decisions and adjust your strategy as needed. One effective strategy for managing risk and potentially increasing returns is dollar cost averaging, or DCA. This involves investing a fixed amount regularly, weekly or monthly, rather than making large one-time purchases. DCA can help smooth out the effects of market volatility and reduce the impact of poorly timed investment decisions. Adam Trademan, CEO and co-founder of BRD Wallet, emphasizes the importance of consistent investment. He said, "Dollar cost averaging ends up making sense in the long term. If you contribute a little bit every time, in the long term, you end up with a pretty darn good return if you can weather all the ups and downs." When it comes to long-term holding, often referred to as HODLing in the crypto community, versus active trading, most successful investors find a balance between these two approaches. HODLing can be a good strategy if you believe in the long-term potential of a project and don't want to stress about short-term price fluctuations. It's also more tax efficient in many jurisdictions. As you navigate the crypto market, it's crucial to be aware of common pitfalls and how to avoid them. One of the biggest risks in crypto investing,
no one can build a portfolio for you,
is falling for scams or fraudulent projects. Always be skeptical of projects promising guaranteed returns or using aggressive marketing tactics. Conduct thorough research before investing in any project, focusing on the team's credentials, the project's technology and use case, and its community support. Emotional decision-making is another pitfall to avoid. The crypto market's volatility can trigger strong emotions
about cryptocurrency, as this is all very risky and very
leading to impulsive buying or panic selling. Stick to your investment strategy and avoid making decisions based on short-term market movements or fear of missing out. Building a winning crypto portfolio isn't about quick gains. It's about steady strategic growth.
Behind the scenes of somebody who has created multiple seven-figure portfolios.
Focus on diversification, risk management, and long-term projects that will stand the test of time. If this video helped you, hit like and subscribe for more crypto investing insights. And in the comments, share your strategy. How are you structuring your portfolio? See you in the next one.